Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're talking about money. So I want you to imagine early morning, Friday, January the 6th. Prior to the opening of the market, the jobs report is coming in first thing when the market opens. The Fed has been raising interest rates. The Fed is trying to cure inflation. People in general want to see jobs and no pressure from wages. They want to see the report coming in showing that the Fed is having an impact, raising rates. And suppose you're one of the journalists, suppose you're one of the commentators, and you know that if the job reports comes in strong, of course the market is going to crash. And if the jobs report comes in weak, the market should do okay, do well. And so the job report comes in, and it's very strong. And instead of crashing, the market takes off and goes up the other way. You've been preparing for this, but how do you explain it? The market has surged up and the report was too good. In Thinking Fast, Thinking Slow, the authors talk about what you see is all there is rule. That neither the quantity or quality of the evidence counts for much in subjective confidence. The confidence that individuals have in their beliefs depends mostly on the quality of the story they can tell about what they see, even if they see very little. And you and I as investors, when we listen to CNBC or when we read about that in the paper, we don't really think about the evidence that should be critical for the judgment or the evidence that's missing. We tend to settle on a coherent pattern of activation, and we suppress the doubt and the ambiguity. And that's what happened on the morning of January 6th as people groped for an explanation. And they came out with explanations that, maybe it wasn't the jobs report. Maybe it was the wage increase wasn't as much. Or maybe it was this. Maybe it was that. You know, I always find that fun and interesting to notice how they search for an answer, and they come through with all the confidence in the world saying, that has to be it. That has to be it. It reminds me of August the 24th, 2015. I have used this example before. I like this example because the market opened and it plunged 1,000 points in the first 5 minutes. It just plunged. And it shocked everyone. CNBC, the Wall Street Journal, all the news services. They couldn't figure out what was going on. And I read a quote. The U.S. stock market sank, bobbed upward, and ultimately sank again on Monday in what many financial journalists and Wall Street bigwigs described as a wild ride worthy of the history books. The reporting on what the numbers meant was as dizzying as the market themselves. Often ominous horse race journalism charted the swings and searched for a culprit, which they tried to explain with ease and guide long-term investors. But by the end of the day, at the end of the day, a fundamental question remained. What the hell is going on? There were plenty of conjecture, and the traders and the commentators at CNBC and the writers from the Wall Street Journal, they reported nobody had a really concrete vision, but they talked about why the prices dropped. And they had explanations like it was Greece, it was Shanghai, it was something international, it was a stock market that was ready for a fall.
It's like the quote from Amos Tversky, I think he's an economic psychiatrist. It's frightening to think that you might not know something, but more frightening to know that by and large, the world is run by people who have faith that they know exactly what's going on.
Oh, yeah. Something like that makes hectic. And this is another quote from Greg David, who said, "Those hectic days like yesterday, tough for financial journalists. People want two things: what's happening and why. And you have to make your best guess as to why it's happening." But their guesses were all over the place.
Oh, yeah, of course. It's the simple answer, Mike. There was if the market goes down, there was more sellers than there were buyers. Done.
Yeah.
At the end of the day, it's like trying to figure out why your team lost the game. Well, they played worse than the other team. The other team scored more points or runs, right?
Well, yeah. It's like when the Seahawks made it into the playoffs. I mean, there was a big article that someone wrote that the reason why the Green Bay Packers lost and the Seahawks are in is because their big linebacker got kicked out of the game for...
That wasn't the reason I watched the game.
But it was a complete article. This guy gets kicked out. I mean, you just don't lose one player and lose a game.
No, it reminds me of one other quote from a Woody Allen movie. Have you ever saw Crimes and Misdemeanors?
Yeah.
And he's coming out of the New York Public Library, and he says, he's kind of the voiceover comes over and says, something to the effect of all these great thinkers and all these great minds. He says, but none of them have any better answers to the big questions in life than I do. And that's kind of like the markets, right? None of these people have great answers. And the one I love is, and I love the show, is on NPR, is Marketplace, when Kai Ryssdal tries to explain the numbers at the end of the day in like the last 5 minutes, and he gives these, a reason why the market went up or why the market went down, but I don't know how much faith you can actually put in his explanations.
I know. And that's why I love that August 24th, 2015, because it wasn't until a month later, that people really figured it out. It wasn't Greece. It wasn't China. It wasn't a tech bubble burst. It wasn't the market that it. Asia had been down big on Sunday night before the market opened here. And traders had a lot of options. And they were long the options. They tried to sell the options. And a lot of the trading went on before the market ever opened.
Right.
And there was a lack of liquidity. There was a lack of buyers. Back to what you said. More sellers than buyers.
Yeah, I mean, but it's like, I remember 1987. It took them months to figure that one out, too. They didn't have an answer for 1987 on Black Monday, October 19th, for a long time, trying to figure out why did the Dow drop 25% in one day, the largest percentage point drop in a single day ever.
I remember living through that. I came in, I was cold calling most of the time. When that market started down, I just sat and stared at the Quotron. I mean, it was just an unbelievable day.
Yeah.
And I think the best, while there were explanations for it, it was, in fact, the beginning of program trading.
Mm-hmm.
And you had, the computers were not doing the trading themselves, but you had people that were actually pressing a button and selling or buying $25 million worth of stock at a time.
Right.
And one of my clients at the time had been a stockbroker in 1929. And I think he put his finger on the exact reason. He said it was just the market was overwhelmed by the volume. Because these guys would press the button, sell $25 million, but they wouldn't get an immediate playback. And they thought, well, maybe my trade didn't go. Mm-hmm. So they pressed the button again and again. And it was just an overwhelming time. My client talked about 1929 and said, and of course, in those days, they didn't have computers and everything was done by the ticker tape and by tickets. You'd write a ticket for buys and sells. And he said they rented every hotel room in Seattle to try to match up all the tickets. He said it took them days. It was just the number of trades were just overwhelming for what the system would handle. Mm-hmm. And that on October 18th, 1987, it was the first time we traded 1 billion shares in a day. The volume was just overwhelming. But as you say, nobody could figure it out.
No, and to try to put rhyme and reason to it every day, why the market goes up and why the market goes down is it's dizzying. I mean, there are stories, there are cases of, because we're bottom-up investors, we can look at individual companies, why one company dropped 20 or 30% or 15% in a day. We can kind of, that can be explained for most of the time. But for the overall market, where billions of traders are trading, where billions of shares are being traded and hundreds of thousands of people are trading all over the world, to try to put an explanation to it without some big cataclysmic events such as COVID or the war in Ukraine, things like that, it's impossible.
No. And, I have a client and a friend who's a doctor, and he said the ability to diagnose a problem, you get it generally right. You listen to somebody's symptoms, and 90% of the time, whatever you prescribe is going to work. You may not be exact, and most of the time you're not exact of what your diagnosis is. But a real doctor deals with the 10% of the cases which aren't easily diagnosed and where you really have to be a doctor. And I think it's the same with the stock market. 90% of the time, whatever their description is pretty well fits. But it's that 5 or 10% of the time which really makes a difference.
Mm-hmm.
And that's why you use people like us to manage portfolios. And we don't tend to react to the momentary times. We don't tend to react on a short-term basis. As Warren Buffett said, the stock market is a device where it transfers money from the inpatient to the patient. I love that quote.
That's a funny one.
The stock market is a device that transfers money from the inpatient to the patient.
Yep.
We're going to come right back after this commercial break. Don't go away. Got a lot more to say. So, if you've been listening to me on the radio for a long time, I go back to 2008, October of 2008. And in November of 2008, December, January of 2009, December of 2008, January of 2009, I started talking about the low in the market of 2008, thinking it was in November, because the market had plunged down and then it started back up. And I'd found a study done by Edward Renshaw of the University of New York in Albany that had looked at the period of time from 1872 to 1990, and for 42 times he found the market, when it sold off, between 5 and 40%, all the times since the Civil War, that there was a relationship that happened from when the market bottomed to say that it was really a bottom. Of those 42 times, 29 happened during recessions or depressions, 13 happened during good economic times like 87 or 89, 90 or 2020. But what he found is it didn't matter whether it was good economic times or recessionary or depression times. Every time was similar. Every time the market hit a bottom, 90 days later, if the market had recovered by 33%, the market had reached that bottom 3 months earlier, and it continued up. In 1987, the market was down 37%. The total recovery was 9.9 months. It was up 23% in 12 months, and it was up 25% in the second year. In 1990, the market was down 13%, but it recovered. In 2008, when I talked about it, the bottom being in November, I was feeling really good going into January, and then the market turned and went down. Never reached that 33%. It went down, and it hit a low in March. And so I had to reset my time frame, and I waited. And by the middle of June, it showed that the bottom had been reached in March of 2009.
We did the same this year in 2022, didn't we?
We did the same thing.
History
I
doesn't
said-
repeat. It does rhyme, though, right?
June 16th, I said, we've reached a bottom. The market was going up. It went up in July. It went up in August. And then in September, it turned and it went back down to reach a new low on October the 12th of 2022. On January 12th of 2023, the market was up a little over 33%. If that holds, and it held for 42 times up until 1990, it held in 2000, and it held in 2008. It held in 2020. So in 3 times, it's worked, not 3 additional times to the 42. It's been correct 45 out of 45 times. That's 100%. Now we know that things that have never happened before happen all the time, but the odds are that we reached a bottom in October of last year, and we're on our way up.
And plus, what's been happening the first 5 days of January?
Yep. And the Stock Traders Almanac, you mentioned that.
They said that this week, an article I read, that there's an 83% chance that the market will be up this year if the first 5 days of January are positive. In the first 5 days of January, we were up about 1.89% on the S&P 500. Now, on top of that, if we finish the month of January positive, then we're really in good shape. There's about another 75% chance that the market will be up for the year. So,
And for those people that are sitting in cash and have been sitting in cash for over a year, they've already lost almost 10%.
mm-hmm. Yep.
That's the loss in purchasing power. And every month that goes by, they continue to lose. So sitting in cash is not a safe alternative. The safest thing right now is to be in the market, not out of the market.
Yeah, I mean, we talked about that the people trying to explain the markets, the day-to-day up and downs in the markets, it just grates on people's emotions, and that's what keeps people out of the market. And you can't worry about the day-to-day. It's the 4 and 5 and 10 year time frame that you really got to set your mind to and not worry about what's going on tomorrow or the day after that.
And you know, the best way to predict the weather, as we look out and we see that the weather is raining today, the best way to predict is it's going to rain tomorrow. If the sun is out, the highest probability to be right is the sun's going to be out tomorrow. It doesn't have to. That's not 100%. You know.
What did Bob Dylan say? You don't need a weatherman to know which way the wind blows.
So I think the prognosticators, for the people that are journalists, for the newsletter writers, for a lot of people who are managing money, the way they predict the market is they look at the trend and they predict the trend's going to continue. And trends never always continue. And it's true. Don't fight the Fed, and the trend is your friend. But when the trend turns, it's time to be on the other side.
But you don't know when that inflection point's going to happen. And trying to sit there and predict it is... Not many people have done it and done it well. We've gone over this in previous shows of people who've tried to predict and calculate when the market's going to turn, and they fail. And when they fail, they don't just fail like by, okay, we lost a few bucks. They fail miserably.
Yeah.
And their clients fail miserably.
Yeah.
We've talked about many times long-term capital management and how they had to be bailed out, and other funds that just failed miserably when the market threw them a curveball.
It's, trying to be right at the precise time. I've been in the business this year, we'll make it 37 years. And in that time, I have sold a stock one time at the bottom, and I think I've I've bought a stock at the bottom one time, and I've sold a stock twice at the top. I mean, in all those years of experience, you can sell relatively high, you can buy relatively low, but to hit the exact moment, no.
No, just go play the lottery.
Yeah. So, Nate Silver wrote the book, The Signal and the Noise, Why So Many Predictions Fail, But Some Don't. And he talks about the McLaughlin Group, for example. Since 1982, they'd made over 1,000 predictions. 50% were right. You could flip a coin and come out as often as they have.
Yeah, Christina Fang, she's a professor at NYU's Stearns Business School, tracked Wall Street survey of, forecasters. And she came up concluding that, rather than being good indicators of good judgment, accurately forecasting are rare events. And such business success may, in fact, be an indication of poor judgment. She said these people basically make predictions. And it doesn't matter if they can make these, we see them, right? Oh, the market's going to crash. This is, get your money out, right? This is the time. Pull your money out and give it to me because I'll help you. And they don't care how right or wrong they are. They're going to make these wild predictions. And if they're right just once, like some of the guys from The Big Short were right just once, they get to sell books and namings and this and that, and they get their name on TV, and it makes them a household name. But how accurate are their predictions on these to predict these things again? It's really a small statistically. Their predictions very small, and then to predict the nuances of the market going up maybe 10 or 15% and having a decent year, they can't predict that at all.
No,
with very little accuracy.
So probably the greatest expert on forecasting and predicting is Philip Tetlock, who got his degree, wrote his PhD thesis, wrote a book called Expert Political Judgment. And he said that the predictions, and he looked at predictions, a ton of predictions in economics, in political, everything. He said most of the predictions were not any better than random chance, just like the McLaughlin Group. Mm-hmm. Said that those people making the predictions were so grossly overconfident, but 15% of the events they said had no chance of happening did in fact happen. 25% of the things that were table pounding buys, sure things you could count on it, failed. Mm-hmm. Economics, politics, international affairs, it was all of that. And he defined what he called hedgehogs as type A personalities who had big ideas, and foxes, who plethora of small ideas and a multitude of approaches. And he said that some experts were better than others. The hedgehogs were the losers, and they were the most visible. They're the ones that you see on TV. They're the ones you hear about are being quoted on TV, and they're the ones whose opinions are most often cited in media. Mm-hmm. He said the more interviews an expert had, the worse their predictions were. I mean, think about the number one recognized financial person in the world today.
The number one.
Number one. Most recognized. Susie Orman is number 2. Edelman is number 3.
Who's number 1?
Number 1 is Jim Cramer.
Oh, Jim Cramer. Yeah.
Most recognized. And we're coming to a commercial break. When we come back, we're going to talk about his predictions. And we do this often enough that you should know already. But we're going to come back and talk about his predictions anyway. And maybe we'll talk about Larry Kudlow and some of the others who have predicted and made outlandish predictions. Anyway, don't go away. We've got a lot more to talk about. We'll be right back after this commercial break. So, We mentioned Jim Cramer, the most recognized financial person, and I don't call him an expert, I call him a financial person, but he's the most recognized in the country and maybe in the world. No question, he's a type A personality. He's got very emotional, very big ideas. He fits the category of Tatlock's hedgehog. And when you look at the show, and of course I have CNBC on all day when I'm working, and he comes on, and there are some times that I actually listen to what he has to say. Most of the time he's playing in the background and I don't pay much attention. But have you ever noticed no one ever calls and says, I have a losing stock that you gave me? Not one time. He's been doing this for how many years? For decades. He's never had a losing stock. Let me tell you, every time he makes a call on a stock, you never hear that it's a loser. You never hear somebody call up and say, Cramer, you told me I couldn't go wrong buying Bear Stearns at 72, but 3 months later it's at 2. It's lost $70 a share. No, there's a screener who screens the calls and makes sure that the people that are calling in are positive. And it makes it sound like Cramer is always right and never wrong. I can tell you that I'm wrong half the time. Maybe not half the time. I don't know. But I am wrong half the time. And I have to have better returns in the correct calls than in the wrong calls. The best calls have to make up for what the wrong ones are. Jon Stewart, of course, did a program on him, and then that went viral, almost viral. But Barron's did a report on August the 20th, 2007. And CNBC claimed that big money was following Cramer. Barron's found that he trailed the Standard & Poor's by 12 to 16% a year. 12 to 16%. Most money managers are only a couple percent lower than the Standard & Poor's. 2 or 3%. If you're down 12 or 16%, you get fired. And maybe that's why Cramer doesn't run money anymore. He had a hedge fund, but he doesn't run money anymore. Down 12 to 16%. CNBC's response to that was, Cramer's job is educational. He's not a stock picker. They tried to say that he is just teaching. But Barron's found, CNBC said if you bought the stocks and held 1 or 2 months, that his picks would do well. Barron's found that was wrong too. That was false. Have you ever heard an ad from Barron's on CNBC? No. After that article, they were banned from CNBC.
That's funny. You tell that story a lot, and every time I hear it, I still can't. I have to laugh.
I do tell that story a lot. I like that story.
But I read another article, Mike, from Forbes, talking about how Wall Street analysts are horribly wrong at predicting. How come they don't get fired for predicting their inaccuracies of telling the public what the market's going to do? Yeah. You see these guys pop up on CNBC and Bloomberg and stuff. And what I didn't realize that these guys are basically just middlemen. They're trying to they're peddling connections between, the article goes on to say, what is this? Excuse me for a second. Wall Street works as a middleman between public companies and institutional investors. It's rubbing elbows with top executives and portfolio managers. As you can imagine, this unique position allows them to hook up and close doors meetings. He said, then it goes on to talk about insider. Well, they can't give sensitive insider trading. He said, but there's a big gray area here. There's no law that you can't discuss hypothetical ideas. For example, just to use Tesla, Tesla's big shareholder tossed around and correctly suspected that the merger of Tesla and solar systems way in advance. And so as they say, there's a lot of gray area, and so they're hooking up executives and fund managers, and that's what's going on with these. That's what the job of a lot of these analysts are.
It is. And the job of CNBC is to sell advertising, not to get paid if you make money.
Oh, yeah.
The magazines are the same thing. They give more space and validation to those mutual funds that advertise.
Mm-hmm.
I mean, you have to think about, when you're reading an article that says, buy this mutual fund.
Yeah, and there was an article in Barron's maybe 3 weeks ago. I don't know if you saw it, about all the ETFs trying to come up with these, an ETF for every sort of scenario and flavor of the month. And basically the article concluded being, well, at the end of the day, these guys got to sell a product.
Yep.
And so because they basically said the products don't perform, and and everybody glommed onto ETFs away from mutual funds because, lower cost. But these ETFs actually have higher costs. Some of them charge up to 3%.
Mm-hmm.
So there goes your lower cost right out the window. And if they don't perform against a benchmark such as the S&P 500, now you're really taking a haircut.
So, it's surprising to me that investors listen to people and don't realize they have a completely different agenda than do investors.
Mm-hmm.
Their agenda is to sell products. Their agenda is to sell advertising. Way back when, I've been doing stocks for a long time. And I can remember as I built positions, I was able to call up the CEOs of companies and talk to them. And after a while, I gave up because the CEO never paints a negative picture. Actually, I take that back. Way back when, Tacoma Boat, when I talked to the CEO or looked at the annual report, they said, we're in pretty rough financial shape. We don't know if we're going to make it. That was the most honest opinion that I ever got. In fact, they did file for bankruptcy and they disappeared. But if you listen to CEOs, they paint a really rosy picture.
Yeah.
They don't say, oh man, we're in trouble. The competition has a much better product than we do at a much lower price. And we're hanging on by a shoestring. We just hope that we can come up with something even better.
Yeah. You don't ever hear him say that. It reminds me of a news conference with the Indianapolis Colts. Jim Mora was the coach, and he's in a news conference. I don't know if you ever saw this, but you can go look it up. It's really funny, and they're like 3-12 or something like that. And the guy asked him about the playoffs, and Jim Mora's comments: playoffs, we stink. We can't even win a game. And there was a guy who was just brutally honest. He said, we stink. We can't even win a game, and you're asking about the playoffs. But you're not going to hear that from many. But we did have one. One of the companies in our portfolio, they had a very cautiously optimistic forecast, and they were pretty honest about their expectations, which was nice to hear. They weren't just rosy, throwing out, peaches and ice cream. Everything's peaches and ice cream out there.
But some of that has to do with the fact of setting expectations too.
No, I agree. But
because, if you promise you're going to deliver something in 3 months and it takes you 4 months, you're really a dud. But if you expect to deliver it in 3 months and you promise it's going to be 5 months and you deliver it in 4 months,
yeah,
people are really happy because it was a month early.
No, I get that, but I think these guys took a more long-term view, and some of the analyst reports I read on them said they definitely did kind of do that. But I don't think next quarter that they're going to come out and everything's going to be rosy. I think they could have like a so-so next quarter, but their long-term view is what we're after anyways. What you and I are looking for is the 5 to 10 year. We could care less about the quarters so much. We'll listen just because we want the information and learn more about the company. But so I think they were just. I think they did do that a little bit, but I think they were just saying, hey, long term, I think we're going to be fine. Quarter to quarter, things could be up and down.
And I think that's
fair.
That is fair, and that makes sense.
One last thing on that Forbes article about the analyst is that how they're compensated. He said the estimation about 1/3 of an analyst's compensation comes from scheduling private meetings with executives.
Yeah.
So how much time can you spend actually analyzing the market and know what's going on?
Come back to where we started the whole program. Come back to being very confident, being exuberant, predicting things when you have a limited amount of information. So you try to if you can't answer a tough question, you try to find a simpler question to answer.
Yeah, or you find evidence to back up your hypothesis and avoid listening to anything that doesn't fit what you want to present.
Yeah.
Which is not really fundamentally a good way to go about looking at stocks from the bottom up like we like to look at.
And the job of a financial analyst or a financial advisor is actually to be in the prediction business. We have to choose those investments which we feel are going to perform well. And unlike most financial advisors, we're doing stock and bond portfolios, individual portfolios we're managing ourselves. And so it's even more critical for us to be really sensitive to what's going on and to stand with our track record. 2022 was a crummy year, a really crummy year. And yet when I look back over 36 or almost 37 years, the track record speaks for itself. We're not looking for small gains. We're looking for multiple increases in the stocks that we own. We're looking for solid performance in the bonds that we're now adding to portfolios. And we've been out of bonds for a long time. We're beginning to add bonds back into conservative portfolios. But we're in the prediction business. You don't want to buy bonds when the prices are dropping. You don't want to buy you want to be buying bonds when prices are going to be stable.
No, even this, I read in another article, the CEO of Chase Bank, JP Morgan, Jamie Dimon, who was really negative on the markets, came out and says, "Oh, maybe it's not as bleak as I thought it was." So he's adjusted his outlook.
Hang on, we're going to be right back after this commercial break. So let me say one thing. Jack Olivan, I can't remember his exact name, was Harris Trust and now Northern Trust, I believe. The financial strategist, he said, investing is a tough business. It's tough. Making money in the market is a tough thing to do. And I think that's really true. I think that's something that we're in the business for. I think that's when you look at financial planners, their average return is like 5% a year. That's pretty easy to achieve, especially with a market going up 10 or 12 or 15%. I think when you look at what we're in, it's a tough business. And it's tough, not only what we do, but it's emotionally tough as well. When you're riding through a down market, when we rode through 2022, that was a really tough time.
Not fun.
It's not fun. It's not fun to hear from your clients. It's not fun for looking at the reports every month, looking at the machine every month, looking at how we're doing compared to the market. That's a very, very tough time. But having been through this in 2087, in 2008, in 2020, it's a time in which it really shakes out the strong from the weak.
Well, there's an article last week in Barron's on Kathy Wood. Her ARC fund is down 67%. And she's doubling down on a lot of positions. And people, there was other money managers trashing her, saying she's lost her way. But she doesn't think she has. And I don't really think she has either. She buying these, what does she call them? Disruptive technology.
Mm-hmm.
Tesla and these companies that are going to change our lifestyle and the way we live. And so, I mean, I think that, she said, the article goes on to say that investors are leaving her funds, but she still has about $6 billion, I think, in the fund, which is a nice chunk, still a nice chunk of change. But it's going to be like Peter Lynch all over again, I think, with her. It's like people are going to leave her fund, and then as it starts to track back up again, people are going to want to get in. They're going to get in at the top, and they're going to lose money over time as her fund does really well.
It's Buffett, you know. Buffett had lost his touch. Buffett was done.
Yeah.
Oh, that was 2000.
Yeah, 2000 he was done. And since then, the A share went from 42,000 to 500,000.
Yeah. So yesterday there was a webinar, Oxford Research, and they talked about predicting whether we were going to have a hard landing or soft landing. And one of the parts of their graphs and their forecast going forward was the number of building structures has been declining now for 6 months. If you look at the number of
building high rises and things, and
office
such.
buildings,
Office buildings, yeah,
apartment buildings, and so on.
sure.
And I asked the question, which they would not answer. I asked the question, haven't we just experienced a lifestyle change? 40% of the people want to work remotely. 5% of the people said they will quit if they're forced back to the office. 40% of the people have said, if we're forced back to the office, we're going to look for a different job.
No, I have a friend that his wife works for King County, and the King County said they don't want her back to the office.
Yeah.
They don't want them back downtown.
I mean, our building in downtown is 47% empty. 47% of the offices are empty. There's entire floors that have no one on. And, you know, the building in Safeco Plaza, Liberty Mutual, had 17 floors. I know that 8 floors are leased for the next 6 years that are completely empty. The people are working from home. And maybe it's more than 8 floors. I rode in the elevator with a person from Liberty Mutual the other day, and he said his boss requires him to come to work one day a week. This is a difference in lifestyle. And when you're trying to project forward, saying we're building fewer office buildings, that is part of a response to the Fed raising interest rates and making it more expensive to build. I think your causal reason is completely wrong. But that doesn't mean that they won't sell that program. And they went through, and they had a number of issues like that. And I raised question after question because it was a webinar. You were supposed to put in your questions. And so I wrote my questions out. I wrote questions. They said, you know, the labor market is getting weaker. I said, wait a minute. We have 4 million jobs, more jobs than we have labor force. How can you say that the labor market is getting weak? You know, they didn't answer my questions at all. They didn't want anything controversial. They answered a question like, what's your favorite leading indicator? I mean, the questions that they answered were all non-controversial, were all straightforward, you know. There was no...
Who was that with? Did you?
Oxford Research.
Oxford Research, okay.
They're trying to sell stock research and
Yes,
trying to sell
yes,
mutual
right,
funds.
right,
and they're
right,
trying
right.
to come out, and that's the big thing people do right now, is to sell their research, to sell their mutual funds.
Mm-hmm.
They put on webinars,
Yep.
and they're talking hard landing, soft landing. I said, you never talked about the possibility there's not a landing, that the economy moves forward on a positive basis. I said, one of my questions was, GDP was up in the third quarter. It was up in the fourth quarter. Why do you expect the GDP to be down in the second quarter of next year? And not only down 4%.
What was their answer? Did they answer it?
Well, they wouldn't answer
They
my
wouldn't answer the
question.
No.
I mean, and I could be completely wrong. They could have really good reasons for their, you know, I just wanted to hear the reasons why they're projecting GDP to be down 4% in the second quarter of 2023.
Mm-hmm.
That seems really crazy to me. And they're sure that there's going to be a recession beginning in the second quarter. You know,
Well, that's funny because that's I just mentioned about Jamie Dimon. He thinks we already went through the recession. That was his reasoning. He's like, I think end of 2022 and that middle period, we kind of already went through it.
You know,
We were in it because we had the 2 negative quarters of GDP, and we had the oil prices skyrocket. We had food prices skyrocket. Things started to settle and started to come back down. The market bottomed from what we said at 35.20 on October, I forget, 12th. I think it was 12th you said, right? So I think he's starting to think, well, wait a second, we've already went through this. And I think other people are starting to see the same thing.
it may very well be. Anyway, we're coming to the end of the program. We need to wrap up. I think we started the program saying people that are journalists, people that are commentators on TV, people that are trying to answer the question of what happened and why, and they're trying to do it immediately, most often, or a good part of the time, are wrong. It makes sense to focus on the long term. Back to the quote I used before. Warren Buffett said it, and I believe it 100%, that the stock market is a device to move money from the impatient to the patient. If you don't have a long-term outlook, the chances are your money's going to move to those people who do have a long-term outlet.
I'll use a quote that my mother used to say when I was a kid, Mike. She'd say, don't believe what you hear and half of what you see.
It's really true. Anyway, that wraps us up for this weekend. Have a very good week, a good weekend, and we're off to a very good start in 2023.